Hello everyone, Rahul Shah here, trying to make investing accessible and profitable for the average investor. Now, of all the big well known companies in India, perhaps none has confused investors more than Asian Paints. Here's a company that's a household name. It's on our walls. It's a fantastic business. And yet, for the last 5 years, if you bought its stock, you've made pretty much nothing. Now, recently the stock jumped on news that competition might be easing, and everyone's asking, is it time to buy? Is the pain over? But to answer that, we need to zoom out because the real story of Asian Paints isn't about the last 5 years or the last news report. It's a 20-year story that reveals a classic and costly mistake that investors make all the time. It's a case study in flawed market behavior. Today, we're going to break down exactly what happened and how you can avoid this trap forever. Let's go back to the year 2000. The 2 decades that followed were nothing short of magical for Asian Paints. The numbers are just staggering. Over 20 years, the stock delivered a mind boggling 150 times return. A small investment became a fortune. But this golden run had two very different chapters. The first chapter, from 2000 to 2010, was a story of pure explosive growth. The stock went up 15 times. How? The company's earnings, its actual profits, grew by around 7.5 times. It was executing brilliantly, expanding, and dominating the paint market. But that was only half the story. The market's love for the stock also doubled. Now, this is measured by the price to earnings ratio or the PE ratio. It's simply the price you pay for each rupee of a company's profit. In 2000, the PE was a reasonable 16. By 2010, it had expanded to 32. So investors were now willing to pay twice as much for the same rupee of earnings. This doubling of the PE supercharged the returns. Now enter the second chapter, 2010 to 2020. Asian Paints was now a giant. It's simple physics. The bigger you are, the harder it is to grow at the same speed. So its earnings growth slowed down, though it was still impressive, growing about 3 times in that decade. But look at the stock. It went up 10 times. Now, how is that possible if profit grew only 3 times? Once again, the PE ratio did the heavy lifting. It expanded another 3 times, from 32 to nearly 100. This PE expansion was the rocket fuel that created the legendary 150 bagger return. And this is where the market's behavior becomes completely flawed. Let's think about this logically. In the first decade, when Asian Paints was growing its earnings at a blistering 7.5 times, the market was cautious, only slowly raising the PE. But in the second decade, when the growth rate slowed down, the market fell in love and sent the PE ratio into the stratosphere. Do you see the paradox? The market paid the highest price when the future growth was slowing down, not when it was accelerating. This is the heart of the mistake. By the start of 2020, the new decade began with a PE ratio of nearly 100. Let that sink in. A PE of 100 means you are paying 100 rupees for every single rupee of the company's annual profit. For that to be a good deal, the company must grow its earnings at an insane rate for the next 20-30 years. It's a near impossible task, even for a superstar. And as we know, what is unsustainable eventually breaks. The first 4 years of this decade were okay, profits grew a bit, but then reality hit. Fierce competition led by new players like Birla Opus entered the market. In the most recent year, Asian Paints' profits fell by over 30%. And what happened to that sky high PE of 100? Well, it came crashing down to around 65. The result? The share price today is roughly where it was 5 years ago. Investors who bought at the peak blinded by the past success, have seen zero returns for 5 whole years. The 150 bagger miracle is now in the rearview mirror. The math simply doesn't work anymore. So, what are the timeless lessons from this entire story? While the news might be positive now, these principles are what will protect your money for a lifetime. Lesson number one: the price you pay is everything. Alarm bells should have started ringing when the P touched 100. Paying such a high multiple is one of the riskiest things you can do in the stock market. You are betting on a perfect, uninterrupted future. The world does not work that way. Competition, regulation, economic cycles, they all happen. A high PE has no room for error. Even the best company can be a terrible investment if you overpay for it. Lesson number two: growth naturally slows down. This is perhaps the most important law of business physics. Trees don't grow to the sky. The faster and higher a company grows, the more likely it is that its growth will slow. Now, we investors have a dangerous habit of looking at the recent past and assuming it will continue forever. We see 20% growth for 5 years and we extrapolate it for the next 20. In reality, size becomes the enemy of growth. A giant like Asian Paints growing at 25% a year forever is a fantasy, not an investment thesis. Lesson number three: separate the business from the stock. Now, Asian Paints is without a doubt a wonderful business. It has strong brands, great distribution, and healthy profit margins. But a great business does not always make a great stock. The stock is determined by the price you pay for that business. You can own a piece of the best company in the world, but if you pay 100 years worth of earnings for it, you're setting yourself up for disappointment. Now, the investors who made a fortune in Asian Paints did so when it was a good company available at a reasonable or good price. The investors who are sitting on zero returns for 5 years are the ones who bought a great company at a crazy price. So let's bring it all together. The Asian Paints story is a classic case of flawed market behavior. The market undervalued its growth in the early high growth years and then overvalued it when growth was maturing. The lesson is simple and powerful. Always, always connect the price you are paying to the growth you can realistically expect. Before you buy any stock, look at its PE ratio. Ask yourself, is the company's expected growth rate justifying this high price, or am I just paying up for past performance? Remember, the biggest investment mistakes are not made by buying bad companies, but by buying great companies at absurd prices. So the next time you see a blue chip stock trading at a sky high valuation, think of Asian Paints and its 5 years of zero returns. Let that be your guide. Well, that's all from me today. I'll see you again in the next session. Goodbye and happy investing.